I want to start today with a chart because I've been looking at a chart that, to be honest, makes absolutely no sense to me.
Oh, I think I know which one you're talking about.
If you pull up the ticker for PolyMedicure, that's PolyMed on the Indian exchanges, what you see is, well, it looks like the perfect manufacturing business on paper.
It really does.
Yeah.
I mean, it's almost the textbook definition of what you'd call a quality compounder.
Mm.
It ticks all the boxes.
All of them. So you have EBITDA margins that are consistently hitting, what, 26, 27%?
Yeah, which is just, it's unheard of for a company that fundamentally works with plastics. You just don't see those numbers.
And then you look at the balance sheet, zero net debt. I mean, they've built this entire global empire without taking on any real leverage.
And that's after building, what, 12 manufacturing plants across 4 countries? It's incredible. Plus, you've got a return on capital employed, the ROCE, that sits comfortably between 20 and 33%.
Exactly. So the fundamentals, they just scream, buy this and hold it forever.
They really do.
But then you look at the price action over the last year, and the stock is down nearly 40% from its highs. It's just bleeding out.
And that's the disconnect.
It is. So on one hand, you have a business that manufactures the invisible backbone of every hospital. We're talking 1.5 billion devices a year. It's a staggering number.
It's almost hard to comprehend.
But on the other hand, the market is treating it like a tech stock that just completely whiffed on its user growth targets. So what's going on?
I think you've hit on it. It's a classic collision between operational excellence and what you might call valuation gravity. And that's really what we need to unpack today.
Right. Is PolyMedicure a falling knife that you should just stay away from? Or is this one of those rare windows where the market has completely, totally mispriced a long-term winner because of some short-term noise?
That's the billion-dollar question, isn't it?
Let's get into it. This is the deep dive on PolyMedicure.
Let's do it.
Okay, so before we get into the financial forensics of why the stock dropped so much, I think we need to understand the business itself, the moat, so to speak.
Absolutely, because that's where the whole story starts.
Because when I first hear the term medical disposables, my brain immediately goes to one word: commodity.
Right. Cheap plastic.
Exactly. I'm thinking of plastic straws, forks, cheap tubing. So my first question is, why isn't this just a complete race to the bottom on price? Why hasn't some massive factory in China just come in and completely crushed their margins?
And that is the single most important question you can ask about this company. Honestly, if this were just about molding plastic, you're right. PolyMed would have been out of business 10 years ago.
So what's different?
The differentiation is entirely in the medical part of medical disposables. We are not talking about consumer plastics here. We're talking about devices that go inside a human vein or an artery or a kidney.
Okay, so high-stakes plastic.
Incredibly high stakes.
Yeah.
Let's make it concrete. Think about something like a central venous catheter. This isn't just a simple tube. It's a precision-engineered device, sometimes with multiple lumens, that has to sit in a major vein right near the heart for weeks at a time.
Okay.
If there is a microscopic burr, a tiny imperfection on the plastic, it can cause a blood clot, a thrombosis. If the material isn't perfectly biocompatible, you can get a systemic infection, sepsis. If one of the connectors leaks, the patient could literally bleed out.
So the moat is basically built on the fear of killing someone.
In a way, yes. But more specifically, it's the regulation that is designed to enforce that safety. And this is where the business model gets really, really interesting and hard to replicate.
Okay, break that down for me.
To sell these devices in a major market like Europe, and Europe is a huge market for them, about a third of their sales.
34%, I think.
Right, you need to get something called EU MDR certification.
The medical device regulation.
Exactly. And getting MDR certification is not like getting a driver's license. It is a multi-year, multi-million-dollar ordeal for each individual product family.
For each product,
Yeah.
not for the whole company.
For each category. You have to prove clinical safety with data. You need to show complete supply chain traceability down to the specific batch of polymer resin you used. You need rigorous, documented quality control. It's a mountain of paperwork and process.
And PolyMed has this.
They've been navigating this regulatory maze for decades. They have over 300 patents globally. They've spent the time and the money to build this regulatory wall.
So just to be clear, if I'm a random manufacturer in, say, India or China, and I have a bunch of injection molding machines, I can't just wake up tomorrow and decide to start selling IV sets to a hospital in Berlin.
You wouldn't even get your email answered. You wouldn't get in the door. The regulatory barrier is the wall. PolyMed has spent years getting certifications for over 50 of their product categories. That is time and capital that a new entrant simply hasn't spent yet.
So it's a kind of regulatory arbitrage.
That's a perfect way to put it. They're competing on the world stage with giants like Becton Dickinson or B. Braun or Medtronic, but they're doing it with an Indian cost structure, all while meeting the exact same high regulatory standards.
That explains the defense. It explains how they protect their turf. Let's talk about the offense. How do they grow? You mentioned Becton Dickinson. That makes me think of the classic razor and blade model.
It is, but it's actually even more aggressive than the classic model.
How so?
So the big OEMs, the original equipment manufacturers, your Siemens, your GE, your Fresenius in the dialysis space, they sell the capital equipment, the big iron.
The MRI machines, the dialysis pumps, the stuff that costs millions.
Exactly. That's the razor. It's expensive. It's a one-time purchase. It has low turnover. Once a hospital buys an MRI, they aren't buying another one for 10, maybe 15 years.
Right.
POLYMED sells the blades, the IV cannulas, the blood bags, the dialysis tubing kits. Every single patient that walks through that hospital door needs a new sterile set. It's consumable, it's recurring, it's beautiful.
The gift that keeps on giving for the company.
It is. But here is where PolyMed really disrupts the traditional model. They aren't just the cheap, generic alternative to the OEM's blades.
What are they then?
They are the high-spec alternative that costs 20 to 30% less than the OEM's own branded consumables.
Ah, okay. So they're not just competing with other small guys. They're going right after the big player's most profitable business.
They are eating the OEM's lunch on the high-margin consumable side. Think about it from the hospital's perspective.
They're under huge cost pressure. Always.
Massive cost pressure. So if a hospital CFO can buy a catheter that is FDA approved, that is CE marked for Europe, that is clinically identical to the big brand name, but it costs significantly less, it's not even a question, they're going to mandate that switch to save money.
And that's the sweet spot you were talking about.
That's what we call the organized middle.
Define that for me, the organized middle.
Okay, picture the market as a pyramid.
Yeah.
At the very top, the peak, you have the global giants we just talked about. They're expensive, high-tech, dominant in Western markets.
Got it. BD, Medtronic.
Exactly. Then at the bottom of the pyramid, the wide base, you have what's called the unorganized sector. These are local, small-scale manufacturers. They might, cut corners on quality. They mostly serve rural clinics or less regulated markets.
And PolyMed is right in between those two, the Goldilocks zone.
Precisely. They are far too sophisticated and regulated for the local players at the bottom to copy. That's the regulatory moat we discussed.
Right.
But they are lean and efficient enough, because of their Indian cost base, to undercut the global giants at the top on price. So they capture market share from both ends.
How?
They capture the volume from the bottom players who are getting squeezed out by stricter government regulations and formalization, and they capture the value from the top players who just can't compete on cost for these high-volume disposables.
That organized middle positioning sounds great in theory, but let's look at the macro picture. The outline says they export to 125 countries.
Yeah.
That sounds impressive, but it also sounds like a logistical nightmare. Where is the actual growth coming from? Is it just selling more and more IV tubes to the same hospitals year after year?
It's a mix of two things. It's volume and it's value. So first, let's talk about the volume. The demand here is what you'd call unavoidable.
Non-discretionary.
Exactly. If we go into a deep global recession next year, you'll stop buying a new iPhone, you'll cancel your vacation, but you will not stop getting your kidney dialysis.
True. You can't exactly tell your doctor you want to defer a heart attack until the economy picks up.
You can't. And the demographics here are just relentless. They're a massive, unstoppable tailwind. By 2030, we're looking at 1 billion people over the age of 60 on this planet.
1 billion.
In India alone, which is their home market,
Yeah.
about 10% of the population will be over 60 by then. And old bodies, well, they break down. They need more surgery, more management for chronic diseases, more dialysis. It's a rising tide that lifts all boats in this specific sector.
Okay, but demographics are a slow burn. That explains a steady 3, 4, 5% growth. It doesn't explain how this company was growing at 20% plus for years on end.
You're right. That's where the second factor, the turbocharger, comes in, and that's the formalization of Indian healthcare.
What do you mean by formalization?
India is urbanizing at an incredible pace. We're seeing this massive shift away from small, informal nursing homes and local clinics.
The mom and pop clinics.
Exactly. And a shift towards large corporate hospital chains, the Apollos, the Max Healthcares, the Fortis networks, these huge professionally managed hospital groups.
And I'm guessing a big corporate hospital chain doesn't buy sketchy catheters from some guy in the unorganized sector.
Correct. They can't. They have strict protocols. They have to get accreditations like JCI Joint Commission International to attract medical tourism and insurance patients. They must buy certified, high-quality, traceable disposables.
So as the Indian market itself gets more professional.
The addressable market for a company like POLYMED expands much, much faster than just the simple population growth. They become the default go-to supplier for this whole corporate hospital boom.
Okay, that makes sense. The macro story holds water. Let's open up the hood now and look at the engine. I want to go back to that 26% EBITDA margin you mentioned.
It's a beautiful number.
It's an astronomically high number for a manufacturing business. So how are they sustaining that? Usually when you have margins that fat, competition just pours in and erodes it over time.
It really comes down to two things they do exceptionally well: vertical integration and automation.
Okay.
So first, vertical integration. POLYMED isn't just an assembly shop that buys parts and puts them together. They make their own molds. They design and build some of their own specialized manufacturing machines. They control as much of the process as they can.
Which gives them control over quality and cost.
Exactly. And second, and this is maybe even more important, they have deployed robotics and automation aggressively.
So we're talking about robots making plastic tubes?
It's the only way to achieve that level of precision and consistency at the scale they're operating at. We're talking over 100 robots and more than 350 molding machines running around the clock.
What does that automation get you?
Well, you reduce your labor costs. That's the obvious part. But more importantly, in this business, you reduce the cost of poor quality.
You mean rejects, scrapping bad parts.
It's rejects, it's rework, and most of all, it's liability.
Yeah.
In medical devices, a defect isn't just expensive, it can be fatal. If you ship a bad batch of cannulas, the recall costs are absolutely massive, not to mention the damage to your reputation.
Right.
By using things like automated vision systems and AI for quality control right on the manufacturing line, they can keep their yield extremely high. And every percentage point of yield improvement flows directly to the bottom line. It's pure operating leverage.
And that ties into the zero debt anomaly. This is the part that really baffles me.
It's very unusual.
They have 12 plants. They're in India, China, Egypt, Italy. They're building new capacity constantly. Usually a company doing that would borrow cheap debt to fund all that capital expenditure.
Why are they debt-free? Are they just allergic to leverage, or is the cash flow just that strong?
It's the sheer strength of the internal cash flow. It's a cash-generating machine. They generate enough operating cash to fund all of their capex for expansion and still have money left over.
And they reinvest it.
A huge amount. They reinvest about 89% of their profits right back into the business.
That is a staggering reinvestment rate.
It is. And it's the classic sign of a true compounding machine. They don't need to go to the bank because their customers are effectively funding their growth through those high margins and a really efficient working capital cycle.
Which makes them anti-fragile.
Totally. Think about the last 2 years. When interest rates spiked globally, companies with heavy debt loads on their balance sheets got absolutely crushed by higher interest payments.
POLYMED didn't even notice. Their interest expense is negligible. They're immune to that particular headwind.
But this brings me to the counter-argument. If they have zero debt and they have, around 150 crore rupees in cash just sitting on the books, are they being too conservative?
That's a fair question.
Could they be growing even faster if they did leverage up and, say, buy a big competitor? Is this a case of lazy balance sheet syndrome?
That's a valid critique you hear sometimes. In pure finance theory, an optimal capital structure usually has some debt to lower your weighted average cost of capital, but I think you have to look at what they're doing with that cash.
Acquisition.
Think of their recent acquisitions. They bought two companies, Medicure and Medicure, for about 240 crore rupees combined.
Right. Let's talk about those because that seems to signal a real shift in their strategy.
It absolutely does. And notice what they bought. They didn't just buy more capacity to make more IV tubes. They bought technology. These are specialized European companies. They specialize in cardiovascular catheters. These are complex devices used in procedures like angiography and angioplasty.
So they're moving up the food chain, moving up the value chain.
Exactly. This is their premiumization growth vector. The basic IV sets and cannulas are the bread and butter. They're steady, they're reliable, but the margins aren't going to explode from here.
But these other areas?
Cardiovascular, renal care and dialysis, oncology, These are the high-growth, high-margin frontiers for them. Their renal care business is already growing at 40 to 50% a year. They even started selling dialysis machines themselves.
So why buy these companies instead of just building the products themselves? I mean, they have 300 patents, a big R&D team. Why not just invent their own heart catheter?
One word: time. It would probably take them 5 to 7 years to design, trial, and get regulatory certification for a whole new class of complex cardio devices.
So this is a shortcut.
It's a massive shortcut. By acquiring these European companies, they bought the intellectual property, they bought the specialized manufacturing know-how, and maybe most importantly, they bought the existing customer relationships with cardiologists. It's a way to jump right into a $20 billion global market.
So they're using that cash pile strategically to buy their way into higher complexity, higher margin segments. That seems smart.
It is smart. It's patient and strategic.
But let's play devil's advocate for a minute. We've painted this picture of a nearly flawless company, and yet the stock is down 40%. The market isn't stupid. What is the market seeing that maybe we're missing in this rosy picture?
The market is seeing one thing, and it's the one thing it hates most, especially for a stock that was priced like this one was.
Which is?
Deceleration. For a growth stock that's trading at a premium multiple, deceleration is deadly.
Walk me through the numbers here. What happened?
For a very long time, POLYMED was priced for perfection. Investors were paying 50, 60, sometimes even 70 times its earnings.
A huge multiple.
A huge multiple. And they were paying that because the market expected 20 to 25% revenue growth every single year, like clockwork, forever.
The classic linear extrapolation trap.
Exactly. And then, at a recent investor meeting, management dropped a bombshell. A small one, but a bombshell nonetheless. They cut their revenue growth guidance for FY26.
From what to what?
Instead of that expected 20% plus growth, they guided for 15 to 16% growth.
Now, hold on a second. 15% growth is still excellent for a manufacturing company. I mean, most industrial firms would kill for 15% top-line growth.
It is excellent. Objectively, it's fantastic. But it's not what was priced into the stock.
Right.
If you're paying 60 times earnings for a stock, you need that hypergrowth to justify the valuation. When that growth rate drops from, say, 22% down to 15%, the whole model breaks. Investors say, okay, this isn't a rocket ship anymore. It's just a really fast car.
And so the PE ratio has to come down.
The multiple contracts, it compresses from 60 times down to, say, 35 or 40 times earnings. And that multiple compression is what drives the stock price down so sharply, even if the underlying earnings are still going up.
So the business itself didn't break. The valuation model that the market was using broke.
Precisely. It's a painful but necessary reset of expectations. And on top of that, there were some margin jitters as well.
What happened there?
In Q2 of fiscal year 26, the net profit margins dipped a bit to around 19%, and the market got spooked. They started asking questions. Is their pricing power eroding? Are rising freight costs finally catching up and eating them alive?
Well, are they? What's the real story there?
There are definitely headwinds. International freight rates have been volatile. Raw material costs. I mean, at the end of the day, medical-grade plastics are still oil derivatives. They fluctuate. But management has been pretty clear that they see this as temporary.
What's their explanation?
They say the 20% growth target is just delayed, not canceled. They're citing inventory destocking in their major export markets as a temporary blip.
Ah, destocking. That's the favorite excuse of every CEO in the manufacturing sector for the last year. Is it a real thing in their case?
It is very real in the medical device world. Think about what happened post-COVID. The supply chain was in chaos.
Total chaos.
So hospitals and distributors, they hoarded inventory. They bought way more than they needed because they were terrified of running out of critical supplies like catheters and IV sets.
They built up a stockpile?
A massive stockpile. Now that supply chains have normalized and delivery times are predictable again, they're working through that excess inventory on their shelves before they place big new orders. It's a classic bullwhip effect.
So it should pass.
It should pass, but in the short term, it hurts the numbers and spooks the market.
Let's talk about the risks that aren't temporary. What could actually derail this train permanently? What's the real bear case here?
The regulatory catastrophe scenario is number one of the bullet.
Okay.
We talked about regulation being their biggest moat, but it's a double-edged sword. It protects them, but it also holds them to an incredibly high standard.
So what happens if they fail?
If POLYMED has a significant systemic quality failure, let's say a bad batch of their dialysis filters causes a series of patient infections in Germany, the regulators don't just fine you. They can pull your license to sell in their market.
And since Europe is 34% of their revenue?
It would be an existential blow. It's not just the lost revenue, which would be huge, it's the reputational damage.
Hmm.
In healthcare, trust is the only currency that matters. If doctors and hospitals stop trusting your brand, you are done. It's a constant, low probability, but very high impact risk.
Okay, what about technological disruption? You mentioned bioresorbable polymers in the outline. That sounds like something out of science fiction.
It's the future, and it's coming. Right now, if you get a metal stent put in your artery to keep it open, it stays in you forever, or it has to be surgically removed later.
Right.
Bioresorbable devices are made from special polymers that do their job, say, hold an artery open for 6 months while it heals, and then they just dissolve harmlessly into the body.
So no second surgery needed to take it out.
Exactly. It's a huge leap forward. And there are companies, especially in the US and Europe, that are pioneering this technology. Now, if the industry shifts to bioresorbables faster than anyone expects, PolyMed's entire portfolio of traditional plastic technology could start to look obsolete.
They risk becoming the Kodak of catheters.
That's the nightmare scenario. They could get disrupted from the high end.
Are they doing anything about this? Are they investing in this area?
They're investing in R&D, of course, but it's fair to say they are behind the curve on the cutting-edge biotech materials compared to the Western giants. Their core strength is manufacturing excellence in current technology,
Yeah.
not necessarily inventing whole new categories of materials science.
That's a really crucial distinction. They are process innovators, not necessarily fundamental product inventors.
They do innovate on product design, they add safety mechanisms to prevent needle sticks, they improve ergonomics, but the core material science they use is largely standard medical-grade polymer.
Let's pivot to the people running the show, the Bade family. They've been running this business for over 30 years.
Yes, Himanshu Bade is the MD and CEO, and the family is deeply involved. And you cannot argue with their track record of execution. It's been phenomenal.
No, we can't.
To take a company from a small Indian exporter to a global player with 12 plants and sales in 125 countries. That is truly elite-level execution over a long period of time.
And they have a lot of skin in the game.
A very significant ownership stake. So when the stock drops 40%, believe me, the Bade family loses more personal wealth than any other shareholder. That alignment of interest is key. They aren't going to do something stupid to loot the company because they are the company.
However, I did notice a line item in the governance report. The executive compensation for the family members is, let's call it healthy.
Healthy is a very polite way to put it. The family members in executive roles collectively took home over 200 million rupees.
And how does that compare?
Compared to the compensation for the independent, non-executive directors on the board, it's a massive gap. Now, is it theft? Absolutely not. They're delivering profits and building a great company.
But optics matter.
Optics matter. When the stock is tanking and minority shareholders are losing money, seeing the promoters take home huge paychecks can rub some people the wrong way.
It's the classic agency problem, creeping in at the edges. You start to wonder, are they managing for the long-term share price or for their annual salary?
Now, I think, given their huge ownership stake, they are definitely managing for the long-term equity value. But high promoter compensation is always a yellow flag that you have to watch. It can sometimes suggest they view the company's cash flow as theirs first and the shareholders second.
Okay, let's zoom out. We have a listener right now who is looking at this wreckage of a stock chart. They see the 40% drop. They've heard us talk about the guidance cut to 15% growth. The big question is this a value trap? Are the glory days of PolyMed's hypergrowth over?
I don't think the glory days are over, but I do think the easy money phase is definitely over.
What do you mean by that?
The phase where you could just buy the stock at almost any price, close your eyes, and watch it double in a year or two, that's probably gone. Now it's a harder grind.
Because the base is just so much bigger now.
It's the law of large numbers.
Yeah.
It is much, much harder to grow 20% on a revenue base of 17 or 18 billion rupees than it was when the base was 5 billion. They have to fight harder for every single percentage point of growth. They have to succeed in these new, more complex segments like cardiology to really move the needle.
But the flip side of that is that the valuation is also much more reasonable now.
That's the bull case. At 35 or 40 times earnings, you aren't paying for perfection anymore. You're paying a fair price for a very high-quality industrial business with strong secular tailwinds.
So if they deliver.
If they can stabilize their growth at that 15 to 18% range and, crucially, maintain those best-in-class 26% EBITDA margins, then the stock could work very, very well from these levels over the next few years.
It reminds me of the story of the Nifty 50 stocks in the U.S. back in the 1970s.
Oh.
You had these amazing companies, the Coca-Colas, the IBMs, fantastic businesses, but they got bid up to insane valuations. They were great companies, but bad prices. The stocks went nowhere for a decade. But once the price corrected and the valuation became reasonable again, they became great long-term investments once more.
That's a perfect analogy. Time heals valuation wounds, but only if the underlying business quality remains intact.
And has it?
As far as we can see, yes. Nothing suggests the fundamental quality of the POLYMED business has deteriorated. The margins are holding up. The balance sheet is pristine. The demand for their products is structural and growing. The moat is still there.
So if I were to summarize our whole conversation, the business is a tank. The stock was priced like a Ferrari. And now the stock price is becoming a tank too.
That's a great way to put it. It's shifting from being a hyper-growth momentum story to being a more boring, reliable, high-quality compounder. And frankly, in the long run, boring is often where the real money is made.
I want to touch on one last thing before we wrap this up, the geopolitical angle.
Right. It's important.
They have a wholly owned subsidiary in China. They have a joint venture in Egypt. They have a presence in Italy. And they export to Europe, which is a huge market. We are living in a world of trade wars, tariffs, and deglobalization. How vulnerable is POLYMED to all of this?
They are highly vulnerable. Let's be clear about that. They are an export-heavy story. If the EU suddenly decides to slap heavy tariffs on Indian-made medical devices to protect its own domestic manufacturers, POLYMED takes a direct hit to the chin.
And China.
If the U.S.-China trade war escalates in a way that impacts their Chinese subsidiaries' ability to operate or export, that's another big problem for them.
But they also have a hedge against this, don't they?
They do, and it's their manufacturing footprint. It's become a strategic asset. By having plants in India and China and Egypt and Italy, they are playing the China plus one strategy perfectly.
So they can shift production around.
They can route production to where it makes the most sense. If Europe blocks products from India, they can try to supply the EU market from their Italian plant. If the U.S. blocks products from China, they can ramp up supply from India.
So it's resilience through diversification.
Exactly.
Right.
It probably costs more to run plants in 4 different countries than it would have one mega factory. But what you buy with that extra cost is insurance. It's insurance against politicians and geopolitical whims.
So let's wrap this all up. We started with this mystery of the falling stock price in the face of a great business. I think we've solved it. It wasn't a crime. It was a correction.
It was a much-needed return to reality. The business is healthy, the demand is structural, the financials are rock solid, but the market's expectations just got way ahead of themselves.
And so for you, the listener, the question is now pretty simple. Do you believe in the unavoidable demand of global healthcare? Do you believe that a country like India will continue to formalize its hospital sector? And do you believe the Bade family has the experience to keep navigating that complex regulatory maze?
If the answer to all of those questions is yes, then a 40% discount on the stock price might look like a very attractive opportunity. If you think the future is bioresorbable plastics that will make them obsolete, or that regulation will eventually strangle them, then you'd want to stay far away.
It's the invisible backbone of the hospital. It's not sexy, it's not AI, it's not a breakthrough drug, but it's the plastic tube that keeps the patient alive. And maybe, just maybe, sometimes that's enough.
Sometimes that's everything.
Thanks for listening to The Deep Dive. We'll see you next time.
Stay safe.